There's some big news this week about the CPI, the Consumer Price Index inflation rate, which is pretty fluffy and not very reliable, but it does say something. We should keep in mind that according to this, Atlanta Fed sticky price inflation CPI, which calculates prices that do not change very often, we are still at highs from 1991, 33 years. So it's a 33-year high in sticky price inflation, 4.3%. Yes, we have descended from all-time, not all-time highs, but since 1978, I think, or something like that.
In today's episode, Rafi Farber discusses key trends in the gold and silver markets. Gold's open interest is resetting lower, with bullion banks closing their short positions. Despite this, gold remains resilient, showing strong market confidence. Silver prices are behaving unusually, with high Chinese buying premiums suggesting sustained. Farber also highlights significant market mechanics, including the impact of open interest on gold prices and the unusual behavior of silver in the Chinese market. Watch to understand these crucial market shifts and their potential impact. Don't forget to like, subscribe.
So yeah, we've descended here, but we're still at highs not seen in a third of a century. So put things in perspective. And now to gold open interest resetting here. I want to show you one of my patented rectangular charts showing correlations in gold futures between open interest and the price. So in this box, we see here that the gold price has descended from about $24.50, from a high of $24.50 to $2,300. You say $150 from $24.50. So that's about 5-6%, something like that. Not much of a move in gold for a move of 100,000 contracts down on open interest. We are at 436,000, 437,000, maybe a little bit lower today. As you watch this, gold did fall a little bit yesterday, which probably means open interest fell further. I would like to see us get back down to 400,000, which cemented a pretty strong bottom back in late February, from which we decided to rocket from about 2,000 to 2450. We could see that again if we descend to 400,000 open interest contracts here, and we're pretty close. So just to show you what happened last time, we fell about 100,000 contracts. We fell here from 500,000 at the beginning of 2024 as the year turned to the end of February. So that took about 2 months. That's it. A fall of 100,000 contracts, and it was only a fall of $100, 4.7%. So after that, we saw a big move, and we're seeing something similar, about $150. It's around the same percentage. And the same 100,000 contract fall. If we can get down to 400,000, that would be about 140,000 contract fall. And then we should be around a pretty firm bottom. This is a chart that I shared on the Endgame Investor, which you can subscribe to for free on Substack, endgameinvestor.substack.com. And this shows the amount of bank reserves being taken up by repos. Bank reserves is the high-powered money that is at the bank account of the banks at the Fed. And there's a total of about $3.4 trillion available now. We can see here why the repocalypse happened. Going into the repocalypse of 2019, the repo markets were getting more and more flooded, more and more crowded, as more and more hedge funds were accessing the repo market to fund their treasury shorts, which is the same thing that's happening now. There's record amounts of short positions in 5-year treasury notes specifically. I don't know why that security, but I do know that the spread between futures and spot in the 5-year treasury notes, futures, and the bonds is about 76 cents last time I checked. And so that's free money that you can get by selling futures short and buying the bonds themselves. So that's why there's so much short positions in 5-year futures, and those futures positions are being funded by the repo markets. So the same thing's happening now as happened back then. We're not at the extremes because we have higher levels of reserves. But the point is here at the high here, which caused the apocalypse, 85% of bank reserves were being taken up by the repo market. We're now at 57%. We've been trending higher since 2022. And when we get near 85%, that should be the next apocalypse where the Fed has to print repos, print money to fund the repo markets, and then print a whole bunch of money besides. The higher we go, the closer we get to that wall is the general point.
Rafi Farber discusses recent developments in gold and silver markets. He highlights gold's resilience despite open interest fluctuations and notes that bullion banks closing short positions may signal a price increase. Farber also points to rising Chinese premiums on silver, indicating strong demand and a potential for sustained price growth. He connects these trends to broader economic indicators like the CPI and past financial crises, suggesting significant upcoming changes in precious metal prices.
Bullion bank shorts near records. So we just did open interest in gold, and this number could be different now. It's on a 10-day lag or something like that, maybe 2 weeks, something between 10 and 14 days. So we do see here that bullion bank shorts are at 226,000, and they've only been higher than that once in 2022. I think this is the March 7th, 2022, our nickel Armageddon, where the entire commodities futures markets across the globe almost crashed when there was a big short squeeze in nickel. But we do see here historically that when we are at these levels in bullion bank shorts, we are typically at highs or local highs in the gold market. It doesn't happen every time, but it did happen these 3 other times. So let's say 75% of the time to reach these levels. So it happened in 2016 at the 2016 high after the end of the bear market. It happened here in mid-2020 leading up to the August 2020 high. And it happened here in 2022 around the nickel short squeeze. So chances are we still need to descend a little bit more. In the gold market. Doesn't mean we have to break this uptrend line, but we could get a little bit lower, and then we'll be at a firm bottom once we hit 400,000 contracts in open interest, and these short positions get covered. Chinese premiums. I've showed this chart before. I want to make it a little bit more concise this time. So I rectangled the 3 previous times when Chinese premiums for silver were at these levels, these consistently high levels of about 13%. So there were 3 times, right? Once in 2011 following the silver top. And that here, if you follow the rectangle, is at this low after the second major sell-off after the $50 top. So meaning this premium came at a local silver low. This premium also came at a local silver low at the end of 2014. And so did this one at the 2020 sell-off when silver hit about $11.50 during the COVID lockdown panic. This is different though, because these premiums are rising even as the silver price continues to rise. So this has never happened before. And it means that there is sustained demand in China. It doesn't mean there's not going to be pullbacks. We just saw one a few days ago. But the Chinese are stacking silver. Exactly why? I suspect it has to do with their falling real estate market, and Chinese need places to put money that isn't in real estate, and they're going back to their tradition of stacking gold and silver, because even in China, it was money and still is. A long-term look at silver open interest. So we have here, we see different stages in this market. In the 1970s, it was very obviously clear that the silver derivatives market, that the silver futures market was being used to manipulate the silver price down. You can see here that open interest climbed to all-time record highs that haven't even been close to being replicated since then. So we have here in the 1970s, this is after the 1974 parabolic top here at about 650, I think it was. And then silver didn't do anything until 1979 for 4 years. So why didn't it do anything for 4 years? Because, well, everything was being done in the futures market, and that was clearly being done to suppress the silver price, stacking huge amounts of paper silver over the available silver supply. And that ended in 1979, 1980 as these positions were being closed, and silver went into a parabolic top that has still not been replicated since. This is the end of manipulation, right? At least as per the futures market affecting the silver price. And we see here that since then, in 2011, when silver hit $50 again, there wasn't much activity in the paper futures market. There wasn't much activity in open interest here. It wasn't being done there. I think this was mostly an ETF-driven rally. It was an SLV mostly, and it could be that retail traders were just chasing it. But we see here that we have an inverse correlation as open interest gets higher from 2011 until 2020, the silver price trended lower. So that was sort of like this, but not as much.